I'm just on China right here and Hong Kong. How much do you worry, or how do you even handicap the PLA going into Hong Kong and what that ultimately means?
Yeah, it's definitely a concern people are thinking about.
But is that a 5% concern? Is it a 10% concern? Is it a 50% concern?
It's not 50%, but it's real. It's not as if the Chinese haven't moved in that direction before in history. Tiananmen was clearly a case in which that happened. And so the chances that the PLA come to Hong Kong is not immaterial.
And are you doing anything as a function of it, meaning with your investors?
I think volatility has increased, and so all the investors that that we have in the firm are looking at this increased volatility and trying to figure out how to actually best position their portfolios to take advantage of it. Whether it's reducing some risk, increasing some optionality in the portfolio, both things are happening at the same time. And underneath that, you still have growth that's actually occurring in many companies, and their stocks are actually behaving well.
You had people sitting in cash for a while because you thought there was this moment that was going to come, this great inflection point.
Yeah, I still think that. Actually, since the last time I was on, the stock market actually hasn't gone up at all. It's basically flat. Cash has been equal to the stock market. Volatility is much higher, and bonds actually have outperformed.
And so what are you waiting for?
I still think you're in a very volatile time period. And I think that the economy is clearly slowing down. Global growth is slowing down. That isn't to say that growth stocks aren't continuing to outperform value, because they are, but growth continues to slow down. And we'd be foolish to think that there are no issues out there.
Ash, you think you should be in cash right now because there's going to be this moment? I don't know if you don't. I don't know. You're not suggesting, by the way, the moment's led by China, though.
No, I'm not suggesting that. And by the way, I'm not suggesting people sell their stocks and go to cash. I just said, if you have cash, are you going to put more in the market or not? Right. I said I would wait.
Ash, what would you do?
So right now, I think you really have to go and think fundamentally, what is the biggest risk that poses a crisis, that poses a true slowdown in real economic activity, so not financial economic activity, but real economic activity. In our opinion, it's inflation. If inflation comes in unexpectedly, then what you're going to see is the Fed is going to have to respond. The era of bad news is good news might be over, and you'll see a very rapid richening in the price of money. And every single recession post the world wars was caused by the price of money trading expensive. So given we believe inflation risk is a much more powerful risk at this point in the cycle than the trade wars, we really like holding gold. So I think we subscribe to what Gundlach has been talking about. Gold is one of the very good instruments that store value and perform well in an inflationary environment. And given all these uncertainties that Peter just talked about, gold should help mitigate the volatility and the movements of the portfolio. So it acts as a nice cushion as well.
So, Ash, when does that inflation materialize? Do you think we still get another couple of cuts this year from the Fed, or is it going to materialize before they're able to do that?
So what I like to call the widowmaker of every single central bank is they have kept the music loud and bright for too long. And hence they had to react very quickly when inflation came. Inflation, I like to think about it as a hibernating bear. When it wakes up, it doesn't wake up slowly. It wakes up very, very aggressively. But the million-dollar question is, when is inflation going to show up in the official numbers? I read probably one of the most fascinating statistics Saturday or Friday, which was the average price or the average trip to Walmart today is 5% more expensive than the average trip a year ago. So you're seeing inflation in consumer prices. You're seeing inflation in retail. And I can anecdotally tell you from my household, I see prices going up each and every month. Why this inflation and these price pressures are not showing in the official numbers, that's an enigma. That's a puzzle. And I think it really goes to it reflects the fact that these official price indices, they're very, very opaque. And it requires someone who has a PhD in economics to understand what's going on. But I really feel conditions are very ripe for inflation to really come in. And you're seeing it in retail numbers. And at the end of the day, retail prices are what's most important.
Ash, do you think the reduction in rates by the Fed have a chance of actually accelerating that latent inflation that you're talking about?
Yes, absolutely true. I am a big proponent that I believe the Fed is committing a policy mistake right now if they go too dovish. Equilibrium would suggest your overnight rate, where the price of money is absolutely fair, your overnight rate equals about your inflation rate. Today, your overnight rate is right around 200 basis points, so pretty close to your inflation rate. So I think conditions today are neutral at the front end. But the back end of the curve, your real rates in the US, for example, your 10-year real rate is 0. Once again, simple macroeconomics would suggest your 10-year real rate should hover around your 10-year real GDP for the country that you're looking at. And we're far below expected 10-year real GDP here in the US, where if you believe the new normal, so the PIMCO type of story, it's 150 basis points. And if you believe reversion back to the mean, it's closer to 200 basis points. We're at 0 basis points right now. Price of money is very, very cheap in the long end. And whenever you have conditions where the price of money is cheap, and if the Fed accelerates the cheapness in the front end, I think this latent or hidden inflation could quickly showcase itself, which then leads to a reactive response by the Fed. And we know in life, when you react, it turns out to be very expensive.